Hi friends, in this video I want to speak about how to pick high growth stocks using a method called CANSLIM method. This method was invented by an American investor called William O'Neill. William basically came up with 7 parameters to pick high growth stocks, and an acronym called CANSLIM was invented. And according to William, if we apply these 7 parameters in selecting the stocks, then we are likely to make good money in stock market. So in this video, I'll walk you through what these 7 parameters are, and more importantly, I will practically apply these 7 parameters and will come up with 10 to 11 high growth stocks for your consideration. You're going to learn a lot of new things in this video. Humble request for you to not skip the video, and also if you like the video, hit the like button. And people who don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. With that, let's get this video cracking. So as you will notice, CANSLIM is an acronym that is made up of 7 characters which are representing the 7 stock picking criteria that William gave us, right? So first letter there is C, that simply means current earnings. What William said is that if the stock's current earning per share has grown by at least 20% on a year-on-year basis, then that means the stock is fulfilling criteria number 1. So for example, the latest results were in Q1 25. So if a stock has generated 20% EPS growth in Q1 25 versus Q1 24, previous year the same quarter, that means the stock has fulfilled criteria number 1. So let me show you how to apply these criteria one by one. So for this, I am going to screener here a free website. You will find the link in the pinned comments or description. Simply click on create a new screen, and what we are going to do is we are going to type here EPS of the latest quarter is what we are interested in, right? And we want this EPS of the latest quarter to be greater than the EPS of the preceding year quarter, right? So if the latest quarter is Q1 25, the EPS preceding year quarter will be Q1 24, right? The same quarter but in the previous year. And we want this growth to be by at least 20%, right? Now higher this number is better it is, but minimum it needs to be 20%. Now I am going to use at least 25% of EPS growth. So how to do that? I am going to simply say 1.25 times is what it should be higher by, right? Now let's go ahead and run this query, and we are going to see that there are only 2,100 companies that have fulfilled this criteria where the EPS growth has been around 25%, right? Now the next criteria, the next letter is letter A, which means annual earnings. Now what William was saying is that it might be possible that one quarter, for whatever reason, a stock might have given 20% of EPS. You can't really look at that in silos. What you need to do is look at the earning per share growth in the last minimum 3 years or 5 years, and you need to make sure that it is also higher than at least 20%, right? So how to build that criteria here? Simply we are going to say, and the EPS growth in the last 3 years should have been greater than at least 20, right? So simply we are going to run this query, and now we have 964 companies out of 2,000 odd companies. 50% companies has not been able to fulfill that criteria. So now we are left with 964 companies that meet both the criteria now. Now we are moving to criteria number 3, which is letter N, which simply means something new. Right here, what William was saying is that if a stock is doing something new, that means that has a very good chances of growing higher in terms of the stock prices. What do we mean by something new? Something new could be a new product or a new offering or a new service that the company is launching. It might be new investment in terms of capex investment, for example, setting up a new plant, new factory, new warehouse, something new, right? Third could be a new joint venture. Fourth could be moving into a new geography or location or expanding the market. Or it could be new management. So there are various possibilities wherein if a stock is doing something new, then there are chances of them making good money. I can't really put that into a quantitative filter here. So what we will do is we will park this particular parameter, and when we are done with all the other parameters, we are at the end going to analyze these stocks on the basis of this parameter as well, and I'll give you some live examples as well. Speaking about something new, if you want to start a new business or you're looking to showcase your skills or achievements to the world, which may land you a high paying job, you can build an absolutely stunning and aesthetic website, that too for free with Odoo. And for this website, you are going to get unlimited hosting and support for lifetime and a free custom domain for 1 year. You can create your free website in few minutes by following 4 simple steps. It's super easy to drag and drop blocks, and more importantly, you can arrange these blocks in any structure that you like. You can add image blocks, and you can give special effects to these images by animating them. There is an Odoo image library powered by Unsplash, giving you thousands of free images to choose from. You can choose a font style that works best for your needs. If you want to use only one app, your first app will be free for life. But if you want more apps, then you can use all of their apps by paying simply 580 rupees per month per user. So check out Odoo today. The link is in the pinned comment or in the description. Moving to letter number 4th, which is S, meaning supply of the stock quantities. So basically what William said is that if the supply of a stock is little or very limited, then what is likely to happen is that it is going to increase the prices of that particular stock in future, because there will be buyers in the market, but the supply is very limited in terms of the stock quantity. So here he is talking about the volume of the stock, and one of the good way to filter out stocks that have very limited supply is by looking at the promoter's holding. So if the promoter's holding of a stock is very high, then what is likely to happen is that the available float, or what we call is the free float of the stock, is going to be very low, and in that case that is going to make sure that if there are buyers in the market, then there is not enough supply of the volume of the stock, therefore the chances of the stock prices going up is very high. So how to apply that filter? What we are going to do is we are going to say and we are going to simply say promoter holding should be, let us say, greater than, I am going to go for 65%, making sure that if the promoter holding is more than 65%, then there is a good chances that the supply of the stock is limited, and if the demand is very high, then the stock prices are going to go up. So I'm going to run this query and see how many stocks we get. Out of 900 odd stocks, now we are only left with 329 stocks that have promoter holding more than 65%. Moving on to the next parameter, which is letter L, meaning leaders. What William said is that a stock needs to be a leader in terms of the price returns or the stock returns in the last 1 year or 2 years, the history. So what William really said is that the stock, to be able to qualify to be selected here, needs to show that in the last 1 year has given very high return in terms of the stock price appreciation vis-a-vis its competitors, vis-a-vis its segment or industry. It's very difficult to find stocks like that, but what we are going to use is a simple parameter that we need to see what is the return that Nifty has given in the last 1 year. So Nifty has given close to 30% return in the last 1 year, and we are going to say that we are only interested in those stocks that have given better returns than the Nifty in the last 1 year. So how to apply that criteria here? We're going to simply say and return over last 1 year. So return over 1 year needs to be greater than Nifty returns, which is around 30%. So let's go and run this query, and we see that out of 329 stock, there are only 260 stocks that have given better returns than the Nifty returns. What we will also do is, once we get our final list, we are going to compare all these stocks in terms of how much of return they have given versus their particular industry returns, so that we can in fact narrow it down even further. Please understand here, William did not say that leaders means the companies that are market leader in terms of the market share or the volume share or the revenue share. What he simply said is the stock should have shown a very good momentum in the last 1 year and should have performed better than their competitors in terms of the price appreciation of the stock, right? So that's the criteria we have used here. Moving on to criteria number 6, which is I. Letter I simply means institutional investments. What William said is that if a stock does not have a lot of institutional buying, then there is a chance that institutions might want to buy that stock, and you need to get in before the institutions start buying that particular stock, right? So according to William, the stock that you are going to pick should have lower institutional investments into that stock, but at the same time you need to make sure that there is 1 or 2 big institutional investor also there, so that you are very sure that you're not buying any Tom, Dick and Harry kind of a stock. You are buying a stock that has been vetted by a big institutional investor. How to put that in the criteria? Let me quickly show you. The criteria we are going to use here is simple. What we are going to say is and FII holding. So we are going to use FII holding. FII is the institution, foreign institution. Plus we want to make sure that DII holding is also considered here. So the total of FII holding and DII holding should be greater than 5%, right? We want to make sure that there is a minimum 5% stakes in that particular company by FIs and DIs put together, but at the same time we do not want that FIs and DIs hold the majority of the share in this stock, because then a lot of buying has already happened and we are not going to be able to benefit from that. So what we are going to say is that FI holding plus DI holding here should be less than 15%. We are going to go ahead with 15% of that particular criteria. So as long as the FI and DI holding is between 5 to 15%, we know that there is a lot of room for more institutional buying to happen in future. And if we buy it now, then we are likely to make good money in the stock market, right? So we are going to run this query and see how many stocks we get. Now we get to only 23 stocks where it has met all the 6 criteria so far. We'll come back to the criteria N, which is the new things that the company is doing, because that's a qualitative one. But now let me speak about the last criteria, which is letter M, meaning market. Here what William said is that this approach of picking the high growth stocks is only going to work out if you see that the market is showing uptrends, right? If the market is in a bull run, then yes, this stock approach is going to work out. If the market is not in the bull run, then this stock approach is not going to work out. Why did he say that? Because in my view also, I think I agree to that statement that a bad stock is also likely to perform in a bull run, while a good stock will also not perform in a bear run, right? So this is a very commonsensical logic that we need to follow. Now we cannot really put that into any filters, but right now if we look at the market, the broader sense of the market, if you look at the Nifty 50, for example, you will see that right now Nifty 50 is showing very bullish pattern because it is trading above 8 out of 8 SMAs. Simple moving averages, you can see 5-day SMA, 10-day SMA. It is trading at a very high level. And in my view, I remain extremely bullish on Indian stock market for the longer period of time. And I created 2 or 3 very good posts on my YouTube member community as well, giving the reasons of why I think I am very bullish on Indian stock market in the longer term. And if you want to get such insights on a daily basis, then you can become a member of my YouTube member community. I do in-depth analysis of stocks, markets, mutual funds, and various other assets that you are going to learn a lot. Simply go to my channel and you will see a join button. Click on that and go through the process. If you're using iPhone, you may not be able to see the join button because there is a YouTube glitch. Give it a try for 1 month and see if that helps improving your investment style or not. Now coming back to this query, we cannot really put that criteria here, but I have given you my view in terms of the market trend. So in my view, market is likely to be bullish in the coming weeks and months. But what I am now going to do is put a last filter, which is market cap, right? What I want to do is I am only interested in those stocks that have shown me market capitalization of greater than, let's say, 5,000 crore, because we really don't want to go and pick up stocks which are very low market cap because there is a lot of risk involved in those particular stocks. Now if I run this query, I'm going to get 11 stocks. Now these 11 stocks have fulfilled 6 criteria out of 7 criteria that we've spoken about as part of the CANSLIM. And you can see the list here. What I'm going to do is arrange this in the order of market cap. So highest is on the top. So General Insurance Corporation of India is the stock number 1 here. You can look at these stock names, but please do not go and blindly invest in these stocks because there are few limitations I see in this particular model that William has come up with. Point number 1, for example, is that he's not considered valuation at all in these criteria, as you can see here. Point number 2 is that he's not taken into account the future earning prospects, order books, revenue guidance, management guidance, nothing of that sort he's spoken about. Thirdly, he's not talked about the risk versus reward ratios that I keep talking about on my channel. If you are not yet a subscriber, consider subscribing to my channel because every week I issue 2 or 3 videos and you are going to learn a lot about stock investing at zero cost. And if you're liking this video, also request you to hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. So what I'm going to do is I'm going to pick up 1 stock out of these 11 and we'll do fundamental analysis, technical analysis, valuation analysis in front of you in the next 3 to 4 minutes so that you know how to go about doing analysis for these stocks, because you cannot just go and blindly buy these stocks, right? So I'm going to pick up the stock which is Railtel Corporation India Limited, and if you look at my screen, you are going to see that in the last 1 year stock has gone up by around 135%. A stock that used to trade at around 210 level is now trading at around 490 level. More importantly, you will see that the stock made a high of 596 rupees, and recently from July 12th onwards it has been coming down, making a bottom of around 452. Now it is trading at around 490. What is the growth driver behind this company? Let me quickly give you 2 to 3 minutes of commentary here. If you look at the financial performance of this company in the last few years, the CAGR in terms of the revenue growth has been very, very good. You can see here in the last 2 years, it's grown by around 29% CAGR, which is a very, very healthy number to look at. Profit after tax is gone up by around 20% CAGR in the last 3 years. I have done this calculation myself, but these numbers look really, really good to me. If I talk about what does this company actually do, many people think that this is only working for the railways of India, but that's not the case. They are into mainly 3 segments: telecom services, data center services, which is also the talk of the town. Many data center related stocks people have been asking me to analyze. I'm going to come up with a video on data center stocks very soon, so hopefully you will get to hear on that. And lastly, they do projects work as well, which is what is driving the main growth of this company. And as I said, Indian Railways is not the only customer for this particular company. Have a look at my screen and you will see that they are working for companies that are into coal segment, telecoms, banking, financial, state government, PSUs. So they have a wide variety of customers using their offering and services. But more importantly, if you see here the financial performance, you will note that there is a pivot going on here. Back in FY20, the telecom used to be the major contributor in terms of the revenues. But in 2024, it's the projects that are driving this growth. And some of that is coming, of course, from railways, which is only 20% of that segmental growth. If you look at the ROCE, ROE number, you will very quickly note ROCE is looking very good, around 18%. ROE is slightly on the lower side, around 13.47%. Company is a debt-free company, which is very good. If you look at the order book of this company, which is what Williams factor could not capture here, this is the analysis we need to do. They are sitting at around 4,682 crores of order book. You can see the breakdown here as well, which is almost, if I look at their revenues, so if I look at the revenues, 2,500 crores is what they did in March 2024. The order book is around 4,600 crores. So there is some visibility for 1 to 2 years in terms of the revenues. Now comes the parameter N, which is the new things that the company is doing, and this is where we need to do qualitative assessment. Let me do it for RailTel Corporation of India. And what you see here is that RailTel has recently signed a MOU with a tech firm for Kavach. What is Kavach? Very quickly, Kavach is a train collision avoidance system, and we need that in India because there has been a lot of tragedies in the recent time where the trains have been colliding. This system is trying to eliminate or reduce the train collisions, which is going to be very useful, and I'm pretty sure that Indian government is going to spend some money into this particular area because this really talks about the safety of passengers like you and me. So this is an example of the new thing that the company is trying to do. How much of revenue this might generate for the company? So it is anticipated that in the next 4 to 5 years, it might bring total 5,000 to 6,000 crores of revenues. It is likely to be around 1,000 crores sort of a business in the next 4 to 5 years. Second example of the new thing that this company is doing is that they are setting up edge data centers at 100 locations throughout the India. Again, this is likely to generate some additional revenues. The company has not given a guidance around how much of additional revenue that is likely to generate. But this is where the Williams point was coming, that if a company is coming up with new offering, new services and new staff, then that means that there is a future earning potential into that company and the stock prices are likely to do well. Overall, if you look at the future earning prospects, the management says that their revenues are likely to grow in the range of 25 to 30%, which is a very healthy rate in my view. Now comes the valuation. If you look at the PE ratio and PB ratio of this company versus many other telecom companies, you will see that it is not overvalued at all in my view. From industry perspective, also PE is trading at a lower than industry PE. And for the ROCE and ROE, this is bringing on to the table. In my view, I don't think this is highly overvalued right now. If you compare this with, for example, railway stocks, then yes, from a railway stocks perspective as well, Jupiter Wagon, Titagar Rail Systems, they are trading at slightly higher PE than this particular company. But from an industry perspective, it is higher than the industry PE of railway stocks, which is actually not railway stocks. This is the engineering industry sector that it has taken. So Rahul, this looks a very good company. Is there any risk in this company? Yes, absolutely. And if you look at the technical chart here, very quickly, you will note that the stock hit all-time high of around 615 rupees level. And from that time onwards, it went down by almost 28% within few days. So there was a deep correction that happened just few days ago. Also, if you look at this deep correction here, stock was trading at around 494 level and it fell by almost 38% within few days. So there's a huge volatility here, and retail people sometimes get really jittery about this huge volatility because the stock will go down by around 30%, 40%. Will you be able to hold this stock at that time or not is the key question you need to ask, because many people get worried. They will exit the stock as soon as it makes 10% or 15% of downwards movement. People will exit the stock. They will say it was a bad stock, so and so forth. But if you see overall, the stock is going up. But that is the risk here in terms of the volatility, which still is out there. Also, sentimentally, if you ask me right now, the railway sector has seen some profit booking, so the stocks are under pressure right now. But I can see that there is going to be good investment into companies like RailTel in the next few years. So future is not all gloom and gloom. It's all about your risk appetite really. Please do not take this as a stock recommendation. I've shown you a method of how to go about analyzing stocks like this that will help you do your own analysis. I hope in this video you learned a lot of new things. If you did, hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. You can also consider subscribing to my YouTube member community if you want to learn on a daily basis. I bring analysis from stock market in a practical manner on a daily basis. With that, I hope you enjoyed this video. I'll see you in my next video. Until then, keep rocking.